You're sitting on your bed with your phone in your hand. Your bank account says $2,300. You made about $5,800 last month. On paper, that's a good income. But somehow, that 2,300 has been the same number for the last 8 months. It never grows. You scroll through your transactions, and it's a mess. There's a $240 dinner from Saturday night, a subscription you forgot to cancel, then another one right below it. Your car payment, your upgraded apartment rent, 2 DoorDash orders from this week alone, and a $34 charge you don't even recognize. You put the phone face down on the mattress and stare at the ceiling. You're not broke. You pay your bills on time. But you have this nagging feeling that you should be further along by now. You don't have an income problem. You have an awareness problem. And by the end of this video, you're going to understand how money actually works better than the people around you. Right now, if someone asked you how much you spend on food each month, you'd guess. If they asked about your subscriptions, you'd guess. If they asked how much of your income you're actually keeping, you'd guess. And every guess would be wrong. This is where it all begins, not with investing or budgets or some fancy app. It starts with knowing your own numbers. So you sit down at your kitchen table on a Saturday morning with a cup of coffee and your laptop. You pull up your bank statements from the last 3 months, because a single month can be weird, but 3 months shows the pattern. You label the 4 columns needs, wants, debt payments, and savings, and you go line by line, dragging every single charge into a column. It takes about an hour, and when you're done, you see it. You spent $1,100 on food last month, and barely any of it was actual groceries, restaurants, delivery apps, coffee shops, and after-work drinks. Over $1,000 on meals and nights out you barely remember. Your subscriptions add up to $187 a month. You're paying for 4 streaming services, a music app, an AI tool you used once, cloud storage, a gym you haven't visited since January, and a meditation app that hasn't brought you any peace. The first skill of financial literacy is awareness, knowing where your money goes before you try to tell it where to go. You cancel 4 subscriptions that afternoon. You tell yourself you're cooking 3 nights a week instead of ordering in, not forever, just long enough to break the reflex of opening DoorDash every time you're tired after work. That's roughly $350 back in your pocket every month without earning a single extra dollar. But awareness is only the beginning, because there's something sitting in your wallet right now that is quietly working against you every single day. Your credit card. You opened it a couple years ago because a coworker told you to get one with travel rewards. You figured you'd pay it off every month and rack up free flights. That lasted about 3 months. Then came a weekend trip you put on the card because you'd pay it off next month. Then new tires for the car. Then a round of drinks you picked up to impress people at a birthday dinner. 2 years later, you owe $6,200 on it. You've been paying around $150 a month, and you feel responsible because you never miss a payment. But here's what the bank knows that you don't. Your interest rate is 22%. That means every night while you sleep, the bank adds a little more to your balance, not just on what you originally spent, on yesterday's interest too, and the day before that. It compounds. You pull out a calculator and punch in the numbers. At $150 a month, it will take you over 6 years to pay off that balance, and you'll pay more than $4,500 in interest along the way. You borrowed $6,200 and you'll hand back nearly $11,000. Those travel rewards, points you've earned so far, are worth about $180. The interest you'll pay on the balance that earned them is 25 times that. Debt is a product. Credit card companies don't make money when you pay on time. They make money when you pay slowly. The minimum payment isn't designed to help you escape debt. It's designed to keep you in it as long as possible. And that same credit card is doing something else to you that you can't see yet. It's wrecking your credit score. You pull yours up for the first time on a free website. The number on the screen says 672. You Google what that means and find out that a 672 instead of a 750 will cost you tens of thousands of dollars over your lifetime in higher interest rates on car loans, worse mortgage terms, and even more expensive insurance premiums. Your credit score is basically a trust rating. Every time a lender looks at you, they see a three-digit number that tells them how risky you are. Think of it like a report card with 5 subjects. The biggest grade comes from your payment history, whether you pay your bills on time. The second biggest is how much of your available credit you're actually using. If your card has an $8,000 limit and you owe $6,200, that looks bad. The lender sees someone leaning hard on their credit. Then there's how long you've had your accounts open, the mix of credit types you carry, and how often you apply for new credit. Every time you fill out one of those Apply Now forms, it leaves a mark. You've been paying on time, which helps, but you're using almost 80% of your credit limit, and that drags your score down. The goal is to stay under 30% of your limit. Under 10% is even better. The good news is that fixing your debt fixes your score at the same time. They're the same fight. So you make a decision sitting right there at the kitchen table. You take that $350 you freed up from cutting subscriptions and restaurant spending and you add it to your credit card payment every month. Instead of $150, you're now paying $500. At that rate, you'll be debt-free in about 14 months. You'll save over $3,000 in interest, and your credit score will climb on its own as your balance drops, without buying any credit repair product or paying someone to fix it for you. The score follows the behavior. You didn't get a raise or pick up extra hours. You just redirected the flow. But now, a question starts to nag at you. What happens if your car needs a major repair? What happens if you get laid off? What happens if you need surgery and your insurance only covers part of it? This is the lesson that separates people who are financially stable from people who are one unexpected bill away from going right back into debt. You need a safety net. Financial people call it an emergency fund. The target is 3 to 6 months of your essential expenses, not your income. Your expenses: rent, food, utilities, insurance, transportation. You add those up on your calculator. For you, it comes to about $3,400 a month, so your target is somewhere between $10,000 and $20,000. That sounds like a lot, but you already have $2,300 sitting in your checking account doing nothing, so you move $1,500 of it into a separate high-yield savings account at a different bank. Online. Out of sight. You set up an automatic transfer of $200 every payday. You don't touch it. You forget the password if you have to. Within a year, you'll have over $6,000 in there, and something weird happens along the way. You feel different. You're not rich by any stretch, but for the first time in years, you're not flinching every time your phone buzzes with a bank notification. The background noise of financial anxiety gets a little quieter, so you keep the automatic transfers running and turn your attention to something bigger. Now, this is where it gets interesting, because up to this point, everything has been defensive. You've been cutting waste, killing debt, building a cushion. That's financial survival. But financial literacy means understanding the next part too, making your money grow while you sleep. You're sitting in the break room at work one afternoon. A coworker mentions the company 401k. You enrolled when you started, but you only put in 2% because that's what the default was. You never changed it. You open the benefits portal on your phone right there between bites of a sandwich. The company matches up to 6% of your salary. You've been putting in 2%. That means your company has been offering you free money every single paycheck, and you've been leaving most of it on the table. You bump your contribution to 6% that afternoon. That's $348 a month from your paycheck, and your company adds another $348. That's nearly $700 a month going into investments, and half of it was always yours. You just never claimed it. But where does that money actually go? This is the part that scares people. Investing sounds like Wall Street traders screaming at screens and staring at flashing red numbers, but the reality is a lot less dramatic than that. Inside your 401k, you pick a target date fund. It's named after the year you plan to retire. The fund automatically spreads your money across stocks and bonds. When you're young, it takes more risk because you have decades to recover from bad years. As you get older, it shifts towards safer investments. You don't have to manage anything, you just let it run. The historical average return of the stock market is about 10% per year before inflation, roughly 7% after. That doesn't mean 7% every single year. Some years the market drops 20% and you watch your balance shrink on screen. Some years it jumps 30% and you feel like a genius. But over decades, the average holds. You run the numbers on your phone calculator. If you invest $700 a month starting at 26 and the market averages 7% per year, by the time you turn 60, you'll have over $1.2 million. You contributed about $283,000 of your own money over those years. The rest, nearly $1 million, is growth. Compound interest, the same force that was eating you alive on your credit card, is now working for you instead of against you. That's the entire game of personal finance, getting compound interest on your side of the table. 6 months go by, you're sitting at the same kitchen table, same laptop, same coffee mug, but the numbers on the screen look completely different. Your credit card balance is down to 3,100. Your credit score just ticked up to 711. Your emergency fund has over 3,500 in it. Your 401k has grown to 4,800, and nearly half of that is money your company gave you for free. You've cut your food spending almost in half without feeling like you're suffering. Nobody gave you a raise. You didn't start a side hustle or win some lottery. You just learned how money actually works, and then you acted on it. A year from now, you'll be debt-free. 2 years from now, you'll have a full emergency fund. 10 years from now, your investments will be doing things that feel like magic, but are really just math playing out over time. Financial literacy isn't a talent you're born with. It's a set of skills you can learn in an afternoon and practice for the rest of your life. You learn to watch where your money goes, understand how debt compounds against you, build a cushion so one bad month doesn't destroy everything, and let compound interest work in your favor instead of the bank's. That's the whole game. Nobody taught you this in school, but now you know. And knowing changes everything. If this helped you see money differently, hit subscribe.